Can you all see the screen now?
Yes.
Hello?
Yeah, we see the bedroom.
The web analyzer?
Coming up.
You guys can't see it yet.
Not yet.
Yes, we see you logging in.
Okay. So you guys do see the screen. That's good. Oops.
Your brother.
Okay. Just a little hiccup here that we're plowing through it. As a matter of fact, let me just go to the Candlestick Bible right now. But yeah. Okay. You see how this is a floor, it's a floor, it's a floor, and so this is the zone of the floor. The floor, you see, it's a zone. It's a zone. It's not exact. Like this coming down, for example. It hits the floor, the floor, the floor, the floor, the floor, and then when it breaks through the floor, like it's an institutional involved, and all that, it hits down to the level, another level of support. But then it bounces up back into that support, which is a ceiling now. This is a zone. It does this whole from here to here is a zone. All the way to here, you see the ceiling, the ceiling, the ceiling, the ceiling, the floor. The supply area. Okay, so and that's how I read it, and that's how it's a zone. It's a zone. So when the secret behind supply and demand areas, and supply and demand areas, let's just keep reading it. It'll probably give us some more wisdom. The demand areas that the big players put their pending orders there when the market approaches these zones, and we see crazy moves from these levels. So when you see it was a strong move in a zone, it could be resistance or support. And then it comes back up to retest that zone. It's a lot of people put pending orders for the move back down. See, what we normally do, we see these long candlesticks, and we know it's work need to be done coming back up. But they say that a lot of people make money by waiting till it come up and reach that supply area then, and then put them pending orders for it to come on down again. And look, there's some meaty candles right there. So it's like when the market approaches these zones, we see crazy moves from these levels. They're at the same level. And to me, that's 100% retrace. It's like we be on the retrace. People be like, man, wait till after the retrace when it hit this supply area. We putting them pending all them sales stops. We putting me some sales stops down here. That's some good wisdom. So if you can combine trading supply and demand areas with the engulfing bar price action signal, you will increase your chances to make money as a trader. Now, this is a bar axe. You know, when you look at that, that's one of those engulfing bar candles and all that. But we just see the double top. You know, the double top give us the same results. You know, but you know, it's telling you how it go. Now, money management trading rules. So far, you have learned how to identify high probability setups in the market. This doesn't mean that all engulfing bar patterns are worth trading. Price action signals with low risk reward ratios should be ignored. Price action signals with low risk reward ratio should be ignored. Do everybody know what that means?
No, sir.
No.
Okay, good. Now, price, okay, what you know what low risk mean, right? And,
Yes.
and let's say you're going down to the penny lot size, and guess what? You got a low reward ratio. You only gonna make about a tenth of a tip, like you're trying to trade consolidation or something. You're trying to scalp a candle that's a pip long, and you're only putting a penny lot size on it, so it's low risk, but it's a low reward too. You're not see if you want to put a penny lot size, you want to get 10 pips, 20 pips, 30 pips. So price action signals with low risk and a low risk reward ratio should be ignored. So if it's not no it's no high profitable stuff, you know, like at least 2-to-1 ratio or you know a 10-to-1 ratio. So once the criteria for high probability setup are in place, there is no more analysis to be made. Just make sure your trade has the potential of at least a 2-to-1 ratio. I know a little bitty stuff. So, you know, like you spending 2 to get, you know what I'm saying. You don't want to spend $100 to make $10. Okay. I mean, the amount of money you will win has to be twice the amount of money you risk or more. See example below. Okay. We got a profit target. So this is the reward if it gets up here. Now here's the demand area. That means this is the floor area, the floor zone, the support zone. Now you got your stop loss right here. So you risking this much to get all this kind of reward. That's a good reward to risk ratio. You see that? Let's say this is 10 pips right here. You're risking 10 pips. And this is 40 pips. The reward is 40 pips.
Hey.
You see? Okay. As you can see, all the conditions were in place to take a buying order. Let's look at it again. You see, yeah, it's at the floor. It's the double bottom. And the stop loss is below the previous wick. And you come on up like that. Okay. So as you can see, all the conditions were in place to take a buying order. The market was ranging, as we discussed before, major demand and supply zones or major support and resistance zones are the best price levels in sideways markets. Now, the formation of an engulfing bar in the demand area is a good trading should I say, okay, in the demand area is a good trading opportunity, but you have to look at the risk reward to make sure that the trade respects your money management rules. Now, this trade has a 3-to-1 risk ratio, reward risk to reward, which increases your chances to be a winner in the long term. Because if you risk $200 in this trade, you are likely to win 600. It is very important to calculate your risk to reward ratio before taking any single trade. This doesn't even apply in the half frequency binary. Yeah, it's up front. Imagine you take 10 trades with a 3-to-1 risk ratio on each single trade. And I mean, when you win, you get $600. And when the market goes against you, you lose 200. See, that's a good risk. So let's suppose you lost 7 trades and you won just 3. Let's do the math to know if you're a winner or, drawdown. So 7 drawdown trades will cost you $1,400. 3 winning trades will make you $1,800. So as you see, you lost 7 trades, but you are still making money. This is the magic of money management. And this is something that really needs to be understood by everyone. Hold
Amen.
on. Okay. Welcome to the call, Cuzzo.
Yes,
So
sir. Good
this
stuff.
is really something to understand now. So you have to want that risk to reward ratio always as much as possible, And sometimes, okay, if we're going to get 10 pips, we're going to risk 10 pips. And that's just a 1-to-1 ratio. It's really, you really want it better than that, really, according to this. And it makes sense. Out of 10 trades, you lose 7 and still win?
Yes, sir.
And what I'm saying is the other way around. We normally win 7, 8 trades out of 10, or 9 out of 10. And a lot of times 10 out of 10. So this is with good money management ratio thing. It's all good. So don't try to be smarter than the rest of the traders. Keep it simple. You know what you're looking for when you identify an engulfing bar pattern and you think all conditions are in place to execute your trade. Take an order immediately at the price action signal. Take your order immediately after the price action signal forms. Put your stop loss below the candlestick pattern and look at simply the chart to find the next support and resistance level. And this is going to be your profit target, and see illustration below. Now, see, they're switching back and forth. They say support and resistance level, and when they say zones, it's supply and demand. That's what it seems like it's doing. Okay. They put the stop loss above the thing. Here's the supply area, the support level. Now they're calling it because it's not two. Okay, it's not a zone. Okay, let's read this again. I'm not looking at what I was reading. Okay. Take an order immediately. Okay, don't try to. When you identify an engulfing bar pattern and you think all conditions are in place to execute your trade, take an order immediately after the price action signal forms. Okay. So the price action, you see the supply area and it broke out and it came on up and we'll get back into that zone. Now, the only thing is they keep saying price action, but it's really supply area candlestick reading. There is no price over to the right. You don't know what price specifically is. That's why they say it's a price action. It's a action. It's a movement, So once it hits this, they put the stop loss there and they sell an order and then comes on down and here's the profit target at the support level. And the reason they know this is even though it broke the support level, but they look to the left and saw that strong double bottom. Okay? So when you set your protective stop and target, don't never look back. Let the market tell you if you are wrong or right. Wow. This will help you trade successfully out of your emotions. Wow. That means when you know that you know that you know, just go for it and set it, win, lose, or draw. Ain't no draw, win or lose. It's kind of like that dealing with the harmonic scanner. Say, hey, you put that stop drawdown in there, you put that entry price, and you put that takes profit, and you set it and forget it. You just gonna hit one or the other, period. And if you got good risk to reward money management ratio, good risk to reward ratio, you still all good, especially when you know what you're doing. So when you set your protective stop and your target, don't ever look back. Now, if you don't set that stop, you better watch your stuff. You better watch them candlesticks like we do. So if the market goes against you, you will not feel good. It's normal. Losing money can be an emotional, it is our human nature. Nobody wants to go on a drawdown, especially when it's about their money, about your money. So in the trading environment, you have to think differently and accept the fact that drawdowns is a part of the game. Michael Jordan and Kobe Bryant, and then they don't hit every shot. So studies have shown that successful traders don't risk more than 2% of their equity on each single trade. So if you're a beginner, don't risk more than 1%. Break it in half. Anthony always say, cut it in half, cuz, cut it in half. So if you're a beginner, don't risk more than 1%. Don't risk money you can't afford on a single trade, even if the engulfing bar pattern you identify indicates a high probability signal. No matter how smart you are, you have to think always in terms of probabilities. Bear in mind that you can experience series of losing trades, and if you risk too much money, you will not survive longer. So now let's look at the inside bar candlestick pattern. The inside bar candlestick pattern is one of the most powerful. Am I hearing a repetition here? Like, CNN say everything is a breaking news story. Well, I've seen the most powerful stuff in here several times as well. But if I hear another most powerful setup, but it is accurate. They are saying some good wisdom here. Okay, the inside bar candlestick pattern. The inside bar candlestick pattern is one of the most powerful chart setups that professional traders look at. However, most traders fail to trade it successfully. So lack of skills and knowledge and poor education are the major reasons why most price action traders don't make money trading the Japanese candlestick. Now, what is an inside bar candlestick pattern? An inside bar is two candlesticks. The first one is called the mother candle. It is big and large, and the second one is a smaller, and it is located inside of the mother. So the inside bar at the bottom, here's the mother candle. That's the big one. A lot of pips on it, meat on it. Then the inside candle is this little doji because it's inside the boundaries of the previous candle. You see that?
Yeah, and it's a morning star.
What do you mean when you say
So that's the inside bar candlestick. Say that again, Benny.
What do you mean when we say it's inside the bounds of the mother candle? What are the bounds? That black.
The bounds. Let's say if you draw a horizontal line straight across the top of that candle and a horizontal line straight across the bottom of that candle, then the doji is inside those horizontal lines.
Okay.
It's inside the boundary, it's inside this previous candle, so to speak.
All right.
The top and bottom.
Thank you.
It's kind of reverse engulfing candle, Okay?
Great.
Okay, so the inside bar at the top, the mother candle is like a reverse engulfing, basically, mother candle. And then the inside candle, this is inside the top and bottom of the previous candle. Welcome to the car. Okay?
Okay.
So the illustration, go ahead.
Does it have to be positioned to the right of the mother candle, or is it always the inside candle is always, we can find it to the right of the mother candle, never on the left?
That's what I'm thinking, because if it's on the left, it's an engulfing candle. It's an engulfing bar.
Right.
So on the right, it's a mother candle. On the left, it's an engulfing bar.
Thank you.
Right.
Okay? But we just normally look at the double tops. So this is a mother candle, and then this is the inside candle. So the illustration above shows inside bars at tops and at bottoms. So as you can see, the second small bar is completely contained by the first one, which is the opposite of the engulfing bar pattern. So the inside bar is seen as a reversal pattern. That's good to know. We see it as a double top, but it's really a mother candle, inside candle signaling a reversal. And we see it the same thing. We call it a double top. So the inside bar is seen as a reversal pattern because it indicates that the market trend is likely to change, especially when it is located at the tops or bottoms, of the support or resistance. So it is also considered as a continuation signal in a strong trending markets. When I say, okay, this will be an evening star, unless it's a strong trend, it's continuation, or this will be a morning star. See the little doji, it signals a reversal. Only if it's a strong trend, it's continuation. So that's what it's saying here. According to Thomas Bulowski, a successful investor and trader with over 30 years of market experience, a bearish inside bar pattern in a bull market going up can indicate a bearish reversal in about 65% of the time. And in a bull market going down, it represents a bullish continuation going up signal in about 52% of the time. So, and let's see if I can illustrate it on the chart. See if we can see a inside bar pattern. I didn't even put the EMA on here. Let's see if we can find an inside bar pattern. Now I see the engulfing right there. Let's see an inside bar pattern. Is that the mother candle? And that's the inside candle right here?
Yes.
Signaling a reversal, like Bridget say, a morning star going up. And then you see this right here, this doji is coming down, but in a strong uptrend, is continuation. Even though this is like a mother and this is a baby, it's just on opposite sides. I mean, the inside candle. Y'all see that? Let's find another example.
Yes, sir. Good stuff.
Okay, good. So basically, what did that look? Oh, no. Where's the other one? Yeah, here it is. Like, that's a morning star. but the doji is engulfed. And then they have it where the doji could be thicker, but it's still engulfed by the previous. It can, let me see that as double top. Okay, let's continue on. The inside bar is a reversal pattern because it indicates that the market trends likely to change, especially in a little bit about that. Okay, it is also considered as a continuation signal in a strong trending markets, according to, okay, I went through all that. And a bullish abandoned baby. God, they got some names for it. And that bullish abandoned baby, as he calls it, is considered a bullish reversal pattern 70% of the time in bull markets and 55% of the time in bear markets. So what he's saying, a bullish abandoned baby, as he calls it, is considered in an uptrend a reversal pattern 70% of the time. That means you're 70% of the time it's an evening star or a thicker doji evening star. I mean, not evening star, morning star, I'm sorry. Wait, and a bullish abandoned baby, as he's considered, in a bullish reversal. That means it was going down, and it's a bullish reversal going back up like this, going back up. Okay? 70% of the time, it's a morning, the morning star. Or even if this is thicker, it's still engulfed by the previous, it's usually a reversal, bullish, 70% of the time. That's good wisdom to know, too.
That's good odds in our favor there, isn't it? It's like 7-to-1 ratio.
Mm-hmm. So the Candlestick Trading Bible, the psychology behind the pattern formations, the inside bar formation indicates a period of consolidation. Now, in case of a bullish trend, it reflects that the bulls are not buying any further on the second day. It is represented by a small black candle on the second day after a strong uptrend. Now, they're talking about day candles, long term. And in case of a bearish trend going down, it means that sellers are not in control of the market anymore. It is reflected by a small white candle, meaning like a little doji, after a strong downtrend. So do you guys get what that is saying? It's saying, inside bar basically is just for illustration purposes. Think of a doji, a smaller candle. It's inside the previous candle. So I'm just gonna say doji, so for understanding purposes, okay? All right. So the inside candle, all of them are not dojis, but they are all inside. They're all smaller, So I'm going to say doji for illustration purposes. So the inside, the doji formation indicates a period of consolidation. In case of a bullish trend going up, that little doji reflects that the bulls are not going up anymore and they're not buying anymore. And on the second day, it represents a small black candle. Oh, that's the doji, I'm sorry. It represents a small black doji on the second day after that strong uptrend. And in case of a downtrend, a bearish trend, it means that sellers are not in control of the market anymore because it's reflected by that small white doji after a strong downtrend. It's getting ready to come back up. Okay, you understand that? So your understanding of the psychology behind this pattern will help you better identify major turning points in the market and time correctly your entry and exit. So how to trade that inside bar candlestick patterns? The inside bar can be traded successfully in trendy markets, particularly in the market if the market is moving strongly. So because the formation of this price pattern provides you with a great opportunity to join the big move. This strategy is very simple. You have to identify a strong trend. Now, we always do that first, and wait for the formation of that inside bar pattern in line with the direction of the market. So the formation of this pattern indicates that the market pauses before making its next move. That's good wisdom. And this will allow you to enter the market in the right time and make big profits. See the illustration below to learn. Okay, trading inside bars and trending markets. We know the market is trending down. Trend is your friend. It's going down. It's going down. So let's say entry after the breakout. What breakout? I don't. Entry after the breakout. Entry after the breakout. Entry after the. Oh, wait a minute.
Okay.
Here we go. See these two candles? This is the baby. I mean the inside, cause it's inside the previous candle. And then you see the little doji, the black doji that signifies it's coming down. So the entry is after it breaks out of this support level, this double bottom breaks below it. Same here. This is this is the mother. This is the mother, and this is the inside. And I call it doji. That, but it's white, like
Okay.
it's
So
going up. But you see that wick pushing down, so the entry point will be under the mother. So all the entry points is under the mother, at the bottom of the mother. Once you see that, what I call the inside, no, I call it the doji, but it's the inside candle. That is continuation. This is something to really study here, because we see it all the time, and sometimes we don't. I don't even be considering these inside bars, but that is a very significant there. When you see an inside bar, to let you know if it's going to be continuation or not, and not going up. That's something good to know. Like, man, this is continuation here. So as illustrated above, the market is trending down. The formation of the inside bar patterns gives us three opportunities to join the trend. If because if it's down here, you be like, oh, that's a double bottom. That thing getting ready to come up. But then you see the little black. Oh man, this is to know its continuation is a good thing to know. So as the illustrated above, the market is trending down. The formation of the inside bar patterns gives us three opportunities to join the trend. Now, if you are used to our trading approach, you will only look for selling opportunities this way. You are not fighting big institutions and central banks. You are just trading in the direction that is favored by the market. You're just following the trend. So you can place a sell order after the breakout of the pattern, that little pattern of the mother and the inside bar. So you can place a sell order after the breakout of the pattern as it is mentioned in the chart above. And your stop order, your stop should be placed above the mother candle. Above the mother candle. Your profit target is the next support level. See another example. Yeah, let me see another example of that. Trading inside bars in trendy markets. Okay, let me blow it up so right. Oops. Okay. Oops. How do I move the screen? Here we go. Okay, the first one. This is a trendy market going up, right? And here it comes up, and then this is the mother, I guess. And then here's the inside, inside candle. So you enter at the top of the I'm not quite understanding this one. 'Cause, hmm.
Okay.
Can you help me with this, Bridget? Because I'm not understanding. See, I'm seeing the mother and the inside candle.
Okay, so at the bottom of the wick for the mother, you're gonna
Hmm.
put in a bar.
Okay, and the stop is at the bottom of the mother. The stop is at the bottom of the mother. The stop is beneath the mother. The stop is below the mother. But when I was reading it, it said that your order should be placed above the mother. Your
Okay.
order. Oh, that your entry is above the mother. Okay, I got it. I had it backwards.
Okay. Okay.
In my mind, I
Okay.
had it backwards. That's all. Okay, I got it now.
Okay.
Yeah, so on the uptrend, that's and you quite clearly see that. You know, the entry is at it's the mother, and this is engulfing. Everybody got this?
But
Any
what I'm
questions?
got a question. Okay, I'm just reading
Hmm.
again what you just read, what you just stated, and it says your stop loss order should be placed above the mother candle. So is that what you were saying? The stop loss and not where you enter the trade?
That was on the downtrend.
Oh, okay,
So you
okay.
can place a sale order after the breakout of the pattern as it is mentioned in the chart above, and your stop loss order should be placed above the mother candle. So let's
Okay,
go above.
on the sale. Okay.
Oh,
Yeah.
That's the
it's
sale.
So that's the
wait,
retrace.
huh?
The retrace.
No.
Okay,
Just a sale,
the
The,
right?
retrace.
the one where the profit is above, the stop loss is above the mom,
Uh-huh.
is the
Hmm.
sale coming down. Where
Oh, let's
the
go
stop
to the here.
loss is below the mom is the buy going up.
Okay,
Gotcha,
got it.
gotcha,
Okay.
gotcha.
Thank you.
Okay.
Gotcha. That's it. I was thinking of it backwards in my mind. So
So are we
from the
looking at
above
two
chart,
different
we can
things?
say that
Dr.
again.
Sam? So are we looking at two different things on the same illustration?
No.
Yeah, we
One
getting we no, we're getting ready to go over the whole thing again with
page
more clarity.
page 141 is a sale. Page 142 is a buy.
Correct.
Yes.
So the entry after the breakout is at the, and it was saying stop, the stop loss is at the top of the mother, and the entry after the breakout is at the bottom. Okay, well that's because we got to get this now. Everybody got to get this. As illustrated above, the market is trending down. The formation of an inside bar pattern gives us three opportunities to join the trend. If you are used to a trading approach, you only look for selling opportunities this way, and you are not fighting big institutions, central banks. You're just trading. Now you can place a sale order after the breakout of a pattern as it is mentioned in the chart above, and your stop loss order should be placed above the mother candle. Your profit target is the next support level. So if this is your entry, your target, your profit is at the next support level. But all it's showing is entries after the breakout. The support level is down here somewhere. This is support.
Mhm.
And so, huh?
So is the
So
entry,
it was saying that the stop loss should be at the level of support of the whole trend, basically. Your profit target is the next level of support. Now, see another example below. So basically, up here, it is saying you enter after the breakout of this pattern. So this pattern is a mother and an inside candle, and then it breaks out of that. It comes below this. See, this is the bottom of the mother and the inside candle. Once it breaks below the bottom of the mother and the inside candle, you can enter on the sale. And then your take profit will be at a level of support. And the only level of support I see here is down here. This is a level of support down here. Or this is
are we
like a
talking,
little,
The
are
ceiling
we
right
talking
there.
a pending order?
no. See, if you see a mother and you see an inside candle, well, this is the bottom of the mother. So this is kind of going sideways, sideways, sideways. But when it break out of this level,
Mm-hmm.
then you can enter for another sale. So anytime you see a mother on a downtrend or uptrend, when you see a downtrend, you see that the mother and the inside, that's the pattern. You wait for it to break. Oh, I see a mother and inside candle. Okay, just go below that now. Come on. Go below that now. Go below that bottom wick on that mother. And then I'm gonna enter.
Right.
When you break below that wick there, I'm entering that sale.
So you're scalping, you're talking about scalping.
Well, it
No,
could
I
be
would call
something, or these could be a day candlestick. It could be a 4-hour candlestick, you know. But the
Oh.
thing is, you enter after this pattern.
Mm-hmm.
If you see a mother and a child, so to speak, a mother and the inside candle in a downtrend, and you missed it up here, you say, okay, I'm just going to wait for this pattern. Okay, I see the pattern again. Now I'm going to wait for it to break out, mean go below its lowest point, and then I'm entering right here. Now when it go down to here, you don't see the pattern. It's going
Range.
like sideways, or the floor, or the level of support, you know. But long as it's trending and you don't see that, okay, I can get in here when it break out of this pattern, and I missed that one. Okay, I can get in here when it breaks out of this pattern, you know. So you see 3 mothers and inside candles formations in this downtrend. So it said, you know,
You
so
see on that too, cuz. You see when you're in there too on all those candles, there was some deep candles there too. Once you enter in, there was some good fits in those candles.
yeah. So that's what it's basically saying. I mean, it's just the breakout of a pattern, as it is mentioned in the chart above, and your stop loss order should be placed above the mother candle. That means your stop drawdown will be above this. The breakout, this is the breakout point at the bottom when it's breaking past that, when it's coming down past that point, that's called a breakout. But the stop drawdown will be above the mother, because it can go right back up to the top of the mother, just like that wick did, just like that wick did. But if your stop drawdown is above the mother, you know, that's what they're saying. Okay, let's see another example below. Now, here is what I had got a little confused on: the trading inside bars in a trending market upward. Okay, now from the above chart, we can see how this price action setup works significantly as a continuation pattern. To be honest, you're not going to take all these signals into consideration. You'd have to look for significant patterns like the mother and the, well, this is, to me, should be the engulfing and the, it should be the other way around. That's what kind of threw me off. So you have to look for significant patterns that form in specific areas in the market, such as support and resistance, Fibonacci retracement, levels, moving average, pivot points. So don't worry about that, because we will learn all about the important trading tools that we will need to use in combination with inside bar setups to make the best trading decisions. So let's look at this chart. Oops, how do I move this? There we go. Now, what we see is this is the pattern. Now they say the entry point is the breakout upward. See, if this is the top of the mother here, you enter when it breaks above that point. That's the entry. And then your stop drawdown is below the mother. Same here. Now this mother, your entry price is when it broke above, it broke out. Like if you drew a horizontal line, matter of fact, you see right here, boom, 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 it broke out. That's the entry for the uptrend. And the stop drawdown is below the mother. Everybody see that?
Yeah.
So, yeah, because we want to learn this stuff. Now, you see this mother here? This is the one that's a little awkward to, because this to me is the entry point. See, this is the mother. This is the inside candle. I understand the stop loss is below the mother, but the entry should be with the breakout. So if you take this straight over, this candle did not break out. Really, it was this one. This is the one you entered on, but they have the arrow over here. See, this one, they had the arrow on the proper candle. This arrow should be, in my opinion, on this candle here. This was the breakout candle when it went above that point. Okay, same here. It's pointing at the top of this candle, but if you go to the breakout, it's this candle right here. This was the breakout entry point right there. And the stop loss, of course, we know is below, below the mother. Okay. So does everybody kind of get that better? Is that more clear, more clarity with that?
On that last example that you just gave, where the arrow, you said in your opinion, is in the wrong place. If it was on the candle above, then it's almost in the same place that the stop loss would be, unless the stop loss would be moved also, isn't it?
No, see the entry price, let's say this is the mother candle right here, right?
Right.
And this is the inside candle. And it says you always enter at the breakout. So for this to break out, it has to go above this wick. So it broke out on this candlestick. You see this candlestick went above this horizontal red line, so to speak.
Right.
It broke above.
So
this, all I'm saying, in my opinion,
okay,
the entry of this arrow should have been pointed to this candlestick over here instead of the middle of the red box right here. So we should understand.
I got that, but what I'm not clear on is if the entry is on the candle above where it's actually pointing to, then with the stop loss still be in the same place as shown
Yeah,
on this chart?
the stop like this has a stop loss down here below the mother.
Uh-huh.
But you see, this stop loss over here is below the mother, but it's a little closer. So it's not a science on the way they draw these boxes and stuff.
Okay.
Just know that the stop loss is below the mother,
Okay, thanks.
and that's your discretion, basically, according to your money management risk to reward ratio. This one is under the mother. This one is under the mother. You know, the entry is above the breakout on this candle. This entry is above the breakout on this candle. This entry is above the breakout on this candle. Okay.
Hey,
Okay.
thank you.
All right. And so that was pretty good. And then we're gonna have a matter of fact, we probably finish this thing out tomorrow because what's tomorrow? Thursday?
Thursday.
Yeah, and I would like to finish it on Friday, but we're gonna finish this tomorrow. So tomorrow we will be at how to trade the inside bar breakout with support and resistance. And that is so important as support and resistance. I mean, it really, really helps. So we'll talk about the inside bar breakout. And we're seeing the breakout right here. That's what we were just talking about. Get in after it breaks out, after it breaks out, after it breaks out. Same up here with this candlestick. After it breaks out, after it breaks out, after it breaks out. So we're going to get more in detail with that tomorrow evening at 8 p.m. Eastern, 7 p.m. Central, and 5 p.m. Pacific Standard Times. We will be doing the candlestick trading vibe on the money trading call tomorrow evening. But guess what? Tomorrow morning, we have Bridget Moore hosting the morning money call where we'll be getting those tips at 8 a.m. Eastern, 7 a.m. Central, and 5 a.m. Pacific Standard Time. Well, we'll be getting those tips. So I'm going to close this call out, this training out tonight. I want to thank you all for being on the call. I want to thank God for God, and I want to thank all of you for being on this incredible journey that we're on. And so we'll be talking in the morning.
Thank
Thank
you
you.
all
Be
so
peaceful,
much.
team.
Okay, and thank you, Bridget. Thank you, Benny, for good questions. And
Yes, sir.
okay, see you guys in the morning. Have a good
All
evening.
right.
This
Good
way.
Good
job, cuz.
night, guys.
Thank
Good
you,
job,
cuz.
Good job.
See you.